All I'm going to do here is introduce somewhere our moderator. We just heard from asset owners. We're now going to talk with asset managers and insurers on climate change. And I'm thrilled to introduce Maryland State Treasurer Nancy Kopp. She has been at this for a long time, with us for a long time. She will moderate this panel. She was elected in 2002. She is Maryland's Chief Financial Officer, serves on many of their boards, including the Board of Trustees of the Maryland State Retirement and Pension System. She's been an active member of our investor network and a great leader, a clear thinker on the need to integrate climate into the work of their pension funds. Thank you, Treasurer Kopp, and I will leave you to your panel.
Thank you, Mindy, and good afternoon, folks. After hearing several great panels, including one of fellow asset owners, we now are focusing on the asset managers and insurers. We have 5 outstanding participants. I'm just going to introduce them very briefly, and then we're going to try to do 3 rounds of questions, 3 minutes each. This is not my forte, I have to tell you, but we're going to try to do it. Sitting with along in alphabetical order, Emily Chu, the Global Head of ESG at Manulife Asset Management, and also Chair of the Asia Investor Group on Climate Change. She's based in Hong Kong. We're going around the world now. Rakhi Kumar, Managing Director and Head of ESG and Stewardship at State Street Global Asset Advisors in Boston. Hugh Lawson, Global Head Institutional Client Strategy at Goldman Sachs Asset Management here in New York. Nancy Pfund, Founder and Managing Director of DBL Partners in San Francisco. And then going all the way around, Maurice, Tulloch, CEO, International Insurance at Aviva in London. And I'm going to ask each of our panelists 3 rounds of questions, focusing first on how their funds approach climate change, second, on what climate-related products and strategies they offer, and third, on corporate stewardship, engagement with climate risk and opportunity. And so I'm just going to ask our speakers to be brief, starting with Emily Chu. And Emily, actually, while brief, has a two-part question. First, how is Manulife Asset Management responding to climate change as an investment risk and opportunity? And then second, in your capacity as chair of the Asia Investor Group on Climate Change, how are AIGCC members and other investors in Asia addressing climate change?
Thank you, Nancy. It's wonderful to be here today. So Manulife Asset Management is a third-party asset management part of the Manulife Insurance Group. So we serve institutional investor clients with 383 billion AUM as of last September. And what we're seeing is more and more client demand and RFPs asking specifically around our strategies on climate change, looking at carbon footprinting, asking us for client reporting around this. And what we're starting to, what we've come to the view is that in order for us to be a top-class asset manager, we need to have capabilities in this area, and we need to have a very clear strategy. We are developing our strategy in line with the TCFD recommendations. In fact, they've really come out at the perfect time for us as we're going through our process of rolling out an ESG integration program across our entire asset management business, which includes public equities, fixed income, as well as private asset classes. And so what we have done is establish 2 working groups which will be operating throughout the course of this year, looking at all of the 4 areas of TCFD around strategy and governance, risk management metrics. And what's very important for us in this is involving our investment analysts really from the bottom up. So we've selected a number of investment analyst champions across Canada, the US, and Asia to work really on the modeling and some of the assumptions that we want to use across our firm in order to ensure that this is integrated into our investment decision making. And that's going to be reporting up through a governance structure that already exists for our general ESG integration activities. And then I would say that for our private markets investments in particular, sustainability and climate change considerations have actually always been a heart of the investment value proposition. So through Hancock Natural Resources Group, for example, we have about 13.3 billion assets under management, around 2.7 of which is in upstream renewable energy assets, so a lot of bio feedstock into bio energy assets. And a lot of those investments were actually made before climate change was ever really on the table for investment managers, before it was really considered to be an investment issue. But really, we've integrated certifications and sustainable agricultural management practices throughout our investment portfolio. And what we find is that that is really very much part of the value proposition of those alternative asset classes, which is, diversification of the portfolio, attractive risk and return characteristics, and capital preservation. In terms of the AIGCC, so it was a double-barreled question. I'll try and be brief. I think we've been establishing this group. It's the relatively younger regional network of investment managers and asset owners in the region. We had, I think, a very important milestone for us last September when we held the Asia Investor Group when we held a roundtable for asset owners in Asia, specifically focused on climate change and what asset owners need to be doing. And we're very pleased to have Mizuno-san as part of that discussion, helping to lead other Asian asset owners from Malaysia, Singapore, Indonesia in that room around climate change. And what we're seeing in terms of the asset management community is in Japan, obviously a lot of movement, asset managers starting to roll out stewardship teams and policies associated with stewardship and climate change being an initial focus for that group. In Malaysia, we've got the second largest pension fund piloting carbon footprinting and looking to introduce a pledge for Malaysian institutional asset owners around climate change. In Singapore, we have carbon footprinting being considered by a very large asset owner there. Thailand launching an ESG mutual fund, which is the first of its kind, and in Taiwan, Cathay Financial, a very major financial group for that country, also pursuing a group-level strategy around climate. So a lot of activity across a number of different, very diverse geographies.
Very well done.
So thank you very much. So State Street is one of the third largest investors in the world with $2.8 trillion of assets under management. And the way we look at climate change is we look at both as risks and opportunities, but in three different aspects. One is the fiduciary responsibility we have to our clients as stewards of their capital. Two is the creators of products and solutions that help our clients meet their objectives. And then third, as a listed company, we want to make sure that we walk the walk and talk the talk that we actually promote as an investor. So with regards to fiduciary responsibility, and it's really largely our stewardship program, which as a risk, you heard, we engage with companies to mitigate risk within our portfolio and ask them to focus on how they are reducing their emissions to align with the 2-degree scenario world. But, and as an opportunity, what we are really trying to get companies to do is incorporate climate into their business strategy. So how are you even positioning yourself in a 2-degree world? So you heard that example that Cyrus gave about the Japanese air conditioning manufacturer who had reduced and created a product that was energy efficient. So that's what we want to hear more of from through our stewardship program. With regards to the investment aspect, so we've created a whole bunch of solutions for clients, whether it's low-cost ETFs or fossil fuel ETFs and other SMAs. But from an opportunity side, we see clients really asking about investing in green revenue options, the momentum that companies who are improving their emissions. And more importantly, trying to understand ways to incorporate those insights that we have from stewardship into our investment process, which we think really will differentiate us as an investor. And then finally, on the listed company side, we really are using the TCFD as a platform to evaluate ourselves. So as a risk, we're obviously trying to understand, much like what was just described, what are the metrics we should be looking at, how should we mitigate risk. And as an opportunity, we're looking to and investing in businesses which will be, whether it's the ESG investing business or data businesses, et cetera, that will help position the company for the future.
Great. Good afternoon. Goldman Sachs has been active in sustainable finance and climate-related issues across the firm for some time. You heard Kyung Ah this morning, or at lunchtime rather, talk about our commitment to help our corporate clients deploy $150 billion of investments in sustainable activities. Our research franchise, Goldman Sachs Sustain, has been a pioneer in thinking about climate issues and other sustainability issues in our equity research. And from the asset management point of view, where I sit, we look after $1.4 trillion of client capital. And philosophically, we treat all ESG factors, of which climate risk is a part, as an investing question like any other. And I think you've heard snippets today of some of the important issues that I think are critical for clients to address as they think about climate risk, meaning you can only think about climate risk and opportunity in your portfolio by considering all of the other governance scaffolding that you've assembled to manage that portfolio. And philosophically, we take an advisory approach. We help clients think about that. And let me give a quick example of what I mean. And I think our colleagues from Japan talked a little bit about thinking about a benchmark in a new way. So many asset owners govern their plan by using market cap benchmarks as essentially the main tool to do that. Market cap benchmark, by its very nature, tells you to assemble the weights of your investments in the proportion that the market is today. What it doesn't say is, are you anticipating a discontinuous relationship in the future between carbon and GDP growth and corporate earnings? It doesn't do that. So much of what we're doing in climate investing, seizing the opportunity and thinking about the risk, is thinking about how the future needs to be and will be different than the past. There are certainly ways to anticipate that and think about that in portfolios. Active management is one example of doing that. So we help clients think about what's their approach to integrating active risk in the portfolio. How do you square active risk with some of the passive attributes? And really integrating climate, both risk and opportunity, in a governance framework that is sustainable and holistic across the plan. Because for us, what I've found with clients is that when they identify climate risk in isolation, separate from all of the other conversations about what the right portfolio needs to be, it often doesn't stick. So philosophically, we're very focused on that. We'll come to products in the next question. I would say data has been something that's been discussed today. We've made a tremendous investment in helping parse through all the data out there. I think the next frontier for climate investing is helping our clients be confident that the data that they have is robust and consistent standards, and that's an area that we're spending a lot of time as well.
Hi, I'm Nancy Pfund, founder and managing partner of DBL Partners in San Francisco, and I just want to thank Mindy and Kathy and the teams they work with for inviting me today. It's a pleasure to be here. And I do see a fair number of our investors in the room, so I'm always grateful for your support. So you know who you are, and thank you. So climate change has been a key driver of our firm since we started as part of JP Morgan way back in 2004. That was our first fund, and now we're on fund number 3, which is a $400 million fund. Makes us one of the largest venture capital firms focused on sustainability and impact, where we define that quite broadly. Many people ask us, how do we make decisions to invest in companies like Tesla or SolarCity or Powerlight, some of the big wins that we've had along the way when they're embryonic and there is no real there are no numbers to really guide you. What we have a framework. We call it our kind of sustainability trifecta, and I'm just going to tell it to you and then give you a couple of examples just to give you a sense of how we think about building clean, iconic companies for the 21st century, because that's really what we need to do in terms of transitioning away from a century dominated by fossil. So one, we follow the carbon. We absolutely look at industries that generate outsized amounts of carbon, and we decide, okay, that's an important industry to focus on. We also look at, we want to fix something that's broken. It's broken that 1.3 billion people don't have access to electricity. It's broken that farmers are mortgaging their land and not able to make a living. There are a lot of broken things in this world, so that's something that we look at. And then the third part of the framework has to do with, if we look at an industry and there are the iconic names are 100 years old, it's probably time to invest and create some companies to replace that. And so that leads us to, obviously, electricity and clean transportation. Storage is really the opportunity of our age to firm renewables and allow it to get to 100% penetration in many places. We're looking at Africa because it is where much of the population growth is happening over the next few decades, and we need a middle class there, and we need electricity. So it's a fantastic market. Food and agriculture, again, 30% of carbon comes from that sector, 40% of employment comes from that sector, and there's a huge opportunity to replace some of the names that we're all familiar with. Another area is conservation and resource efficiency. There are no public company, no great private sector names in conservation. There are amazing names in the not-for-profit world, from the Sierra Club, where I used to work, to more recent names. But we need to develop ways to make money on conservation that don't rely on just carbon credits and rebates. And then the final area is space tools and the ability to democratize access to reliable imaging and data, so that not only you follow the carbon, you can find the carbon and figure out how to reduce it with tools that really reflect understanding our Earth rather than just traveling to outer space.
Nancy, thanks for the introduction. Good afternoon, everyone. I'm Maurice Tulloch with Aviva Insurance. So as one of the world's largest insurers, we operate in 16 countries. We have about 450 billion of AUM. So how do we approach climate change? How do we think about it? Well, it starts with the board. It starts with the culture. This has been an active item on our board dating back to the 90s. It's a strategic imperative, both as an insurer and as an asset manager. Last year we engaged the Economist Intelligence Unit to look at this from an independent perspective. And I've got to tell you, the conclusions were very stark. We looked at a 2-degree, 4-degree, and 6-degree scenario. And at a 6-degree scenario, the VAR, or the value at risk, was 43 trillion in global assets. We also, as an insurer, look at extreme weather events, and certainly we've had a number in this part of the world this year. What used to be the 1 in 100 now seems to become the 1 in 5. Paris is having severe floods right now. It was just 2 years ago that we had a 1 in 100. Or I think, as a Canadian, a wildfire in northern Alberta on May 2nd 2 years ago, and it strikes me there should still be some snow on the ground, or at very least the ambient temperature isn't 32 degrees with arid conditions. When we look at our property and casualty insurance business, at a 4-degree rise, we would have to bow out of property and casualty insurance around the world. It's noteworthy that the European Commission released its high-level expert group report today, and they also concurred with the uninsurability of many perils at a 4-degree rise. We also focus on other types of risk, from physical, transition, and liability, and is now informed by the TCFD. We're one of the first insurance companies and financial companies in general to begin disclosing our climate risks and opportunities in accordance with the TCFD's recommendations, and we'll be working to improve and expand those disclosures. Turning to us as an investor. As an investor, we have a 5-pillar approach to climate change. Integration into our business, investment in low-carbon infrastructure, supporting strong climate policies, asset stewardship, and engagement again, finally before, if necessary, divestment. In 2001, Aviva Investors was the first asset manager to formally integrate corporate responsibility into its voting policy. We voted on some 50,000 resolutions and attended some 4,200 meetings. We're also committed to investing in the low-carbon infrastructure, £500 million per year in each of the next 5 years, and the potential for infrastructure renewable investment is immense. However, the supply side is just starting to accelerate. Clearly, this needs to accelerate in order to get off the fossil fuel drug. I'll come back to that later in the next questions.
Thank you. I think it's very exciting that there's some themes that have emerged during the day that are now being fleshed out actually in terms of actual management and hands-on, and it's very exciting. Emily, what climate-related products and strategies have you developed or plan to develop for your clients?
Thanks, Nancy. I'd like to focus on our private markets business, because I think it's perhaps not so well known, and I think that the issues are perhaps quite unique. It's a unique contribution I can make here. So via Hancock Natural Resources Group, we invest in private asset classes on behalf of the Manulife general account, the insurance general account, as well as third-party clients. So we have about 40 funds across separate accounts for around 330 third-party clients in these types of assets, specifically timberland and farmland. So we're the largest institutional investor in timberland globally. Across, we have forests in Canada, the US, Australia, New Zealand, and Chile, I believe. And then we're also around the third largest institutional investor in agriculture investments. So the historical value proposition of these investments is that they provide excellent portfolio diversification. They're low volatility, so they can help with managing volatility in a portfolio. In the case of agriculture, they can be cash generating and also help with capital preservation. And then in the case of timberland, they help protect investors against inflation. However, these characteristics of these assets can really only continue to exist in a world of climate change if climate change is being properly understood, modeled, and managed. So we believe that asset managers need to really asset managers in these particular types of asset classes need to undertake a paradigm shift from just looking at historical trend analysis to modeling forward-looking changes in the environment, capturing the value shifts in growing products, and that this also intersects with other important ESG issues as well, such as changes in urbanization, population shifts, technological developments, etc. So in the case of timberland, for example, the types of risks that climate change poses are potential mandatory carbon sequestration regulation, or carbon regulation generally could limit your management options, your ability to generate profit from these types of assets. Erosion in productivity due to more stressed growing conditions, and obviously a meaningful increase in fire activity, which was a feature of our lunchtime speaker. But then there's also opportunities that these present as well. So there's potentially less physical risk in timberland compared to some other types of annual crops because they have longer growing cycles and less dependence on irrigation. There's more established sustainability certification schemes in timberland, and all of our forests are 100% certified. As the low carbon economy develops, we expect to see more and more demand for use of forests as a carbon sink, and more demand for very tall wood buildings as well. And we think that timberland can be used as an offset or a governor to climate change that have where investors have diverse sets of goals. In the case of agriculture, some of the things we're doing is incorporating scientific analysis of changing weather patterns into our transaction strategy, so which assets we want to actually acquire, and then looking at moving into certain areas that perhaps were not considered to be options for certain crops that are, and as the climate changes, that's actually opening up new areas for new types of crops. And we're also collaborating with our industry peers in agriculture investing to develop a widely recognized and international third-party standard for sustainability in agriculture. One of the challenges with agriculture and with sustainability certifications is they tend to be very specific to certain types of crops, making it quite difficult to report across an entire diversified portfolio of different types of agricultural crops. So we think that by being involved in these types of standards, we're making an asset class that by its nature needs to be sustainable, I think recognized more as being that.
Thanks. A bit over 10% of the close to $200 billion that we manage in ESG strategies are in climate-related strategies. We partnered with the UN Joint Pension Funds to actually create the first low-carbon ETF, which overweights companies in our gives global exposure to investors and overweights companies with low carbon emissions relative to their sales, as well as low fossil fuel reserves relative to their market capitalization. We also partnered to put out 3 different fossil fuel ETFs, and together they have about $500 million in these strategies. But I really want to focus on the future, because I think this 10% that we see, we think it's going to grow significantly. And that's because of the amount of demand that clients have in terms of wanting innovative solutions to address their climate needs. And think of the UN SDGs, which is really driving much of the values that the asset owners are trying to get around. And the climate alone as an issue when it comes to UN SDGs can, through the first and second and third order impacts, address close to 10 of the 17 UN SDG goals. So that's why we feel that this is going to continue to grow. We're investing, I think Hugh mentioned data, and we do agree that you need to have good data to actually create good products. And I think that we are investing in innovative data sets, and more importantly, materiality frameworks that need to be transparent to clients, and so that they understand what's really going into these products. What I do also want to say is some of the things that we internally debate about is what are the policy implications, and our current focus on emissions, and particularly on few sectors, what impact is that going to have? What are some of the unintended consequences which we don't know we are creating through our current policy focus? And so we don't have the answer to that, but we constantly debate that internally to actually try to find more innovative solutions. And finally, I'll say that we're really focused on ensuring that our stewardship program aligns with the products that we are creating. We want to make sure that the impact that we offer our clients to our products is maximized both from an investment perspective, but also from an engagement perspective.
Well, great. At GSAM, we try to have products that across the liquidity spectrum, so in equities and fixed income and in private markets, and very focused on identifying opportunities that advance sustainability and climate-related issues, but also have a robust financial profile, in certain cases that exceeds other investments. And I'll give you an example. We recently launched a strategy that focuses on financing renewable energy in the United States, mostly solar. That's in private markets, essentially. It's a private credit strategy. The essential financial characteristics of it are more attractive today than the mid-market credit financing that you would find in the market. We've got higher counterparty credit, higher yields, better tax treatment, and abundant opportunity. That's a clear win-win and would be an example of something we've done recently. Similarly, we're looking at similar strategies in Japan. It's a very interesting market, more work to do there. That may be something we'll launch later in the year. I think in liquid markets, Comptroller DiNapoli talked a little bit about some of the work that we partnered with our friends at New York State Common, low emissions investing in equities and integrating it into the governance framework that is consistent with the overall rigor of the asset owner is something we focus on. We have worked with other clients with other carbon dimensions and climate dimensions in their equity portfolio. Equally excitingly, which probably gets a little bit less airtime, is really in the corporate bond market. We've developed a number of products and strategies in separate account format that help clients think about climate risk and ultimately get a fixed income exposure that's equivalent to what they had before. Takes a little bit of work. You have to focus on, make sure that your industry concentration is appropriate and issue selection is very important. But we've developed investment grade portfolios that have the same financial characteristics as what the client started with, but doesn't finance companies with fossil fuel reserves and doing other things that are high carbon intensity. The muni market as well is an area where we have products in separate account format in particular. You can finance sustainable infrastructure and you can address a broader range of ESG goals in the social dimension. Lastly, I'd mention in real estate, our core real estate strategies are focused on net zero buildings. It's been a tremendous win when we went back in the portfolio that we'd assembled over time and improved the carbon footprint of the existing assets. That was great for the bottom line. It was great for the climate. So our focus is really where we can have an edge across asset classes to develop solutions, and much more will be forthcoming.
Well, in a venture firm, the products are really our companies, and I could go on all day about the great things that are happening there. Just one example, a company we've invested in, Off-Grid Electric, which sells solar and storage and efficient appliances to countries in Africa. We aim to scale clean distributed energy on that continent and derive all the benefits from an economic development point of view as well as from a carbon point of view. Just one example, we went into Côte d'Ivoire about a year ago and then we had 0 customers. 12 months later, we have 100,000 customers. I mean, that's a very rapid growth, and now we're in Ghana. I mean, we're just going to spread across the continent, and that's how you all of a sudden you turn a carbon problem into a carbon opportunity, and a very lucrative one. But I want to just take a couple minutes to say that in addition to developing companies that scale and that solve problems and that are good investments, we feel it's very important to be metrics-based, and that's something that we offer to both our LPs, our investors, but also to our portfolio companies. Because any of you that have been fighting the battles for clean energy for a few years know that there are people out there that will never believe. But if you attach a shiny, nice job creation statistic or an economic development success to a clean tech company, all of a sudden you're a lot more successful. And so we're committed to metrics. We've been counting jobs, for example, since 2003. And we saw very early, for example, that in the Bay Area where we're headquartered, that our solar and our EV companies were creating many more jobs than our tech companies. And those jobs were going to people that could not ever get a job at Google because they didn't have the training. So we focused on those numbers, and sure enough, as we developed traction in the industry and there was more resistance from the incumbent utilities, the job creation numbers and the diversity of those jobs really helped the industry get through some tough political battles. And so we think it's very important to recognize and we've talked a lot about job creation here today, that we've got the numbers, and we're already way ahead of where tech and life sciences are. We have a long ways to go in terms of numbers and diversity, but the metrics-based approach that we offer can help in Sacramento or Washington, D.C., or the capitals of any country across the globe. And it's a lot of what we do is teach our companies how to do that.
It's a fascinating question when we sort of think about what are our climate-related products and strategies, and how do we think about them with respect to our clients. So certainly as an asset owner, as an investor, I mean, last year our general account invested $300 million in green bonds. This year we financed a large solar wind farm in the UK and a major offshore wind project. And what I'd say is we still need to educate ultimately our retail clients because the demand side needs to also increase. It's not just the supply side. If we think about physical risk, we need to partner more in different countries around the world with governments on public-private partnerships. For example, to understand the impact of climate change, one only needs to look at the cost of property insurance around the world, both residential and commercial, specifically as we've seen a proliferation of, 3 of the perils, wind, water, and fire, all competing to see who's going to win, I think, at times. And how do we ensure the right adaptation, mitigation process are in place? Industry and government need to provide a broader societal response, need to work together to provide a solution and access to insurance, minimize the protection gap, create affordability and capacity. It's a pretty daunting challenge. However, we now have examples where public-private partnerships are starting to reach those collective goals. In the UK, for example, one such good example is that of Flood Re. And Flood Re commenced about 2.5 years ago, and the problem in that small island was 500,000 homeowners effectively faced the possibility of not being able to get home insurance. And Flood Re provided a pooled resource to ensure availability, but also resources to work on water management, construction resiliency, and a moratorium on building in known flood zones. Governments are ultimately the insurer of last resort, but the industry has a responsibility too in working with governments to map out flood zones, fire risks, using the right data, using the analytical skills, and having decisions like the one I've just mentioned in the UK. When it comes to something like flooding, most flood zones have been around for over 1,000 years. They're not that difficult to find and spot.
Thank you. And finally, round 3, getting to the point, what are you doing in terms of asset stewardship, corporate engagement to manage climate risk and facilitate opportunities in the companies that you invest in?
Thanks, Nancy. So for us, engagement is a really important part of our investment process, regardless of climate or anything to do with ESG. We're active managers across all of our portfolios. And in order to scale that up, and I think to make it more effective, we have joined the Climate Action 100+ to engage the world's largest carbon-emitting companies. We'll be reaching out to all of our most significant holdings to engage and establish an open dialogue on climate, including their TCFD implementation and transparency. As well as the Climate Action 100+, we have joined the PRI's methane collaborative engagement, particularly focused on disclosure from oil and gas companies around this particular greenhouse gas and reducing emissions across the oil and gas supply chain. We're raising methane as a discussion point with the relevant companies, also in our individual engagements. And also, I'm serving as the chair of the AIGCC, and what we're doing is working to provide, through that angle, is working to provide the investor members of the AIGCC and also investors in Asia generally with tools to support more effective engagements in the region. So we've convened an advisory group of senior experts to help advise the Climate Action 100+ initiative, for example, and to help us with ensuring that the way in which we're leveraging our international colleagues to conduct engagements in Asia is done effectively. And we're also producing guides around having effective engagement on carbon and climate to help to support those Asian investors who are just newer to the engagement space generally. And then in our private markets business, I already mentioned that we're working on developing a standardized benchmark for agriculture investments around sustainability. But we're also engaging with, outside of our own institution, with partners in academia. So at MIT, we've become a sponsor of a joint program on science and policy of global change that will help sponsor access to historical information, analysis, projections, and modeling capabilities focused on climate change. And we're also involved in another network called Climate Smart Land Network, which is a network of forestry companies focused on climate change adaptation and mitigation. So certainly a lot of, again, I think as was mentioned in the previous panel, a lot of need and a lot of opportunities for us in partnering with other colleagues, peers, and institutions in this space.
So climate change has been a priority area of engagement for us with companies since 2014. And over the 4 years, we've actually engaged with over 280 companies, we've had 280 engagements with 190 companies globally. We've engaged with about 60% of the Climate 100 companies in the Climate 100 list, for example. And what the position that we think as a global investor, the role that we really play is that of being a harmonizer and equalizer in the area of climate change. So what does that really mean? It means that, this morning you heard that there are currently 1,200 legislations, climate-related legislations in 60 different countries. Well, guess what happens when you engage? You have a regulatory arbitrage environment that is created, or legislative arbitrage environment. There are companies in Europe that have very good disclosure, and you have companies in the US or in some other areas who hide behind regulation and don't disclose. And we think we can be the harmonizer. If we believe that climate is a risk to our portfolio, and also that the impacts of climate change don't stop at geographic borders, then we really have to hold all our portfolio companies to the same standard. And that's something we've done through our thought leadership that we've published with regards to how to view climate change, and more importantly, this season, right after shareholder proposals passed, we put out a framework for companies to say that this is how we're going to be analyzing your responsiveness to these shareholder proposals. So we called on companies, for example, to disclose how the governance and oversight of climate risk, that we asked them to establish goals on GHG emissions, long-term goals of how much they want to reduce. We asked them to talk about carbon price emissions, as well as discuss what the impacts of scenario planning is. And really to illustrate how much of an impact we can have as a harmonizer, I'll just leave you with an example. So we were engaging with a US oil and gas company, which really pushed back and is still pushing back hard on the fact that we are asking them to disclose their average carbon price or the range of carbon price assumptions, which we think are important to understand. And they say that it's competitive market information. And the way we responded to that pushback was, well, in that case, how are you really using the carbon price emissions that Statoil, Total, Eni, our European climate companies are actually disclosing to get a competitive advantage? And they can't respond to that. So I think that's just illustrates what the role we play as a steward.
Well, I would say, I think there's at least two dimensions to engagement, and we've made a significant investment and increase in our resources focused on it. I think we're mostly an active manager, and so our portfolio managers, who particularly end up being long-term owners of companies, are very active with managements, and climate is a real focus. I would say, secondly, what's developed that's quite interesting is our very large asset owner clients with separate accounts are increasingly looking to us as a partner with their dedicated engagement efforts. And so they may have particular approaches to it. And so we are very excited to partner with them to advance their engagement goals. But I want to come back to something I said earlier about the data. So when you're engaging with a corporate, you have to think about a frame of reference. So what is a best-in-class approach to a given issue? And I think we find that our credibility is higher with corporate management if we've done our homework to have the data and really understand the given industry and the corporate's position in it in the same way that they may. And I think one of the things that is less effective engagement is if you're coming less prepared than that. And so I would say that our engagement efforts are both how we work with corporates on our own, how we work with corporates on behalf of our clients who have engagement staffs and objectives, and linking that really with data, so you're having an empirical conversation, in essence. The third point on the triangle that we're thinking about that we use the data for is also isolating these things as alpha signals. And there's many claims in the market about what's an alpha signal and how important is ESG to it. It's clearly quite important, and where we've seen material correlations between ESG performance, of which climate is one dimension, but there are others, that lead to corporate outperformance, and you bring that to the engagement discussions, then again, you're also having a business conversation that's constructive. And so what I'd summarize is engagement's critical, our resources in it have grown, but we have integrated the effort into our overall strategy as it relates to data and alpha generation.
As impact investors, we do grade ourselves on community engagement and policy outcomes, so it's something that we're very, very focused on. I will tell you that some of the world's best entrepreneurs are not really that interested in policy. I think many of them would rather spend the afternoon at the dentist than at the California Public Utilities Commission. But it's important, and they realize that you need to bring everyone along. So one of the things that we do is to bring together the various stakeholders. Tomorrow night, for example, I'm moderating a panel for legislators in the California Assembly and Senate, for regulators. Michael Brune from the Sierra Club will be there, and leaders of the clean energy industry in California, and in a very conducive setting to dialogue as opposed to any adversarial aspect. And so, as one of the organizers of this, I'm doing a fireside chat with Mary Nichols, who's the head of the California Air Resources Board, and all the cap and trade that we've all been talking about. We owe her a debt of gratitude for hanging in there for decades to get that done. Obviously, many of our personal heroes. Carla Peterman, who is the first African-American woman to be on the California Public Utilities Commission, a Rhodes Scholar. She is responsible for the storage mandate that has pushed storage into being a very successful industry to invest in, and enables broader climate change goals to be achieved by making renewables at scale feasible. And then Susan Kennedy, who used to be in the public sector working with Governor Schwarzenegger, but now is an entrepreneur leading a company called Advanced Microgrid Solutions, which is leading the way to take buildings like these that have a very one-way relationship with the electricity used herein, and really turn the ability of a building through storage assets, software, and renewable assets to reshape its load and reduce its cost and generate more clean energy. So bringing you may have noticed this is an all-women panel. One of our goals is to show that to improve the gender ratio in venture, in clean tech, and so it isn't by accident that this is an all-women panel, because if you look at the way that storage is coming on the market, it really, the three women on my panel helped to make it happen in a very significant way, and of course that has global implications. So we do this to bring together groups that are often at odds with one another and get them to understand that they need to be responsive to a variety of stakeholders. And now that while we started this in California, we are doing this in other parts of the world where we see the same kinds of barriers take place when the incumbents in Nigeria begin to recognize that there's a new kid in town. The same kind of bad stuff happens that happened in San Francisco. So it's important to recognize that without intervening and community engagement and policy engagement and getting your CEOs to understand that it's important, we're never going to win and get to the levels that we all want to support and make happen in this room.
Asset stewardship, corporate engagement is incredibly important. In fact, I could argue, as a large financial services company, it may be the most important responsibility that we have. We've been incredibly active on engaging companies we invest in on the issue of climate change. Last year in our proxy voting, we voted for 90% of climate-related shareholder proposals. In the past year, we engaged in depth on 45 occasions with 37 companies on climate change in 2017. We also wrote collectively to 4,220 companies to encourage them to complete their carbon disclosure. As I mentioned previously, we will, if necessary, in certain cases, after engagement, also divest. But driving understanding and demand amongst end investors is also crucial. We have a role to play in the education and the broader building of financial knowledge There's tons of data out there. Unfortunately, it's not necessarily accessible or free to all individuals. That's why at Aviva, we're one of the founding partners in the World Benchmarking Alliance, a proposed new global solution to develop corporate sustainability benchmarks, ranking companies, if you like, perhaps in the league table on the Sustainable Development Goals. And as part of the World Benchmarking Alliance, we're consulting on the Climate Action Benchmark, using the recommendations of the TCFD to build the methodology and identify the biggest impact by companies. We have a role in getting companies to understand risks and liability, and the asset side on climate-related loss prevention and developing greater resiliency to extreme weather events and other climate-related business disruptions. But we need to work together. Perhaps, if I may, just a couple of final thoughts to leave you with. The UN, I believe, has a stewardship role, setting new norms so that private finance can achieve the SDGs. For example, exploring how to change capital adequacy rules, clarifying investor duties. It was nice to see the EU has announced today that it's going to review this. And this goes hand in hand with the role of individual governments. Paris showed unprecedented intergovernmental agreement, but we need further government commitment, policies like carbon tax, reducing fossil fuel subsidies, and perhaps TCFD implementation plans.
Thank you. This concludes our panel. We've heard from what several of the world's leading asset management funds are doing to integrate climate risk and opportunity into their businesses, their policies, their investment strategies, their products, and their corporate engagement. Coming through this, I think, through the whole day, is a call to action based on both the asset owners and the managers. There was a time when the managers said, well, they didn't hear anything from the asset owners, so they decided it wasn't that important. That time has passed. And the focus on the need for data, for shared data commonly understood within frameworks that make it usable to move things, such as the TCFD type data. And finally, the reaching out to partnerships, the integration with both investment and governance. In other words, all the things, Mindy, that Ceres and Denise have been doing since you brought me into this 15 years ago. I hope you'll all join me in thanking a terrific panel.
Thank you very much.